be able to see me. Just let me know into the chat box that you can indeed all see me up close and personal by the looks of it. In this one, I want to answer your questions as ever and as before as well. Yep, it looks like I can. Great, works fine. So I really want to get on with just taking you through some of the things which are at the top of my mind. I will focus on exchange traded funds as well. If you see me looking at various different screens, it's because I want to cover a lot of information, give you a good overview as well on this. So I'm going to type a few things in. And I want you to ask me any of your questions as well. So let's just, first of all, whilst you work on questions and so on, let me just show you one of the screens I'm looking at the moment. Oops, no, that's, right, great. You should be able to see a little holding slide. You should be able to see something about my firm. All of that matters less at the moment. That doesn't matter so much. I want you to be careful with brokers at the moment. The spreads are being widened. This is if you're looking at trading. I really want to focus on the investment side at the moment. But if you are looking at trading, just be careful with the widening of spreads and moving things around. If you look at my free site, you'll know that what I have done is listed some of the brokers, which I think are on the sort of safer side, let's put it that way, as well. I don't want to go through this. What I do want to go through is this chart. I want to remind you of this. I'd mentioned this previously. And I want you to be aware of this chart. Now, I said before, when I explained to people and they asked me, Alpesh, is this the bottom? Have we got to the bottom? And I said, no, the major problem of calling a market bottom is this bit. The US was just starting to accelerate. And as it comes out with more negative news, obviously the markets are more likely to get hit. And I will show the markets in just 1 second on that as well. But that was my major concern, that all that happens is we get a little bit optimistic, and before we know it, that we get a bit of a movement down. And let me just explain what I mean by that in terms of if I was giving you where each one of these bars represents 1 day, because we're looking at slightly longer term, then yes, last week we had a few really big up days. Now we're seeing some movement off, and that's what worries me. Well, worries me in the sense that we haven't seen the bottom, which means for those who missed the initial opportunity of getting in, there'll still be an opportunity to do that. For others, we shouldn't panic that, oh, I thought it was all over. I thought it was all over. Yes, we wish that. We wish it with the virus. We wish it with the markets sell off, but we've got to deal with reality. Now, several of the things I'm going to show you in this webinar include, as I say, I'm going to answer your questions as well. But several of the things that I want to ask you, to tell you about during this is I'm going to look at, and I'll just give you a bit of background, Altman scores, which are basically the working capital that companies have and how much profits they've kept in their bank accounts, because that increases their survivability and is a good measure of their financial health in a period like this. And Croki, which is used by Goldman Sachs Asset Management to advise their wealthiest clients. And it is about the ability of a company to generate cash flow. And obviously in this economy, your ability to generate cash flow might be limited by external circumstances. But this is based, again, on working capital and the capacity of a company to at least generate some of those positives that we might want to look at. So one of the things that I want to show you in this is just have a look through various US and UK markets and just see what those numbers look like for us as well. And then we can always drill down, or offline after this webinar, I can always drill down and say to you guys, okay, look what we're going to, I'm going to pull this on screen in just a second. Let me just move this across. Let's see where we are right now with these numbers. Okay, so let's just have a look at some of those characteristics first and foremost, then we'll move on to exchange traded funds. Okay, so you've got Croki, you've got Altman, you've got the movements that we've seen, let's say in the last 5 days and in the last 2 months as well. And I also want to look at my own value growth rating. I'll put that right up there. So let's just start off with the FTSE 350. Okay, we'll look at the US indices, New York Stock Exchange as well, but let's start with FTSE 350, and then we'll look at AIM stocks as well. So this is FTSE 350. Let's just scroll all the way up here, and let's just look at what's been happening over the last 5 trading days. So we've had some moves. Let's go for the big 350 largest companies for a start, okay? And we'll go to the higher risk stuff later. Now, some of these have rebounded. They've come off quite strongly. So we want to know, is this sustainable? Should we be looking to get in? What does this tell us about the companies? And whilst you've had an 81% rise in Aston Martin, and you can see it over there, and before this, one thing which I really want to know, whenever I look at what's happening now, is I want to know, how was the company doing before all of this crisis? If it was either on a steep upward basis or at least going sideways, then I think to myself, well, that's the level at which it should recover. The issue then becomes when. All right, now, is it going to be in 12 months? I'm willing to wait if need be. But I'm not saying Aston Martin is necessarily a good one, because their ability to generate cash, minus 20, their Altman score is under 1.8, which means there's a risk of bankruptcy within the next 2 years. Now, they'll may well get bailed out. They'll have lots of government support. They might be fine. But what I'm saying is, and you might say to me, yeah, but Alpesh, 81% return. I'm saying, yeah, all right, but I'd rather look at others in order to try and get a similar kind of return. All right, and what kind of return? Let's have a look at, say, Energen. What I'm going to do is, you can take a shot at this, right? I'm not going to go through every single one. What I'm going to say is, the higher the Altman score, above 3 is ideal. And the higher the croaky, the better. Negative croakies worry me. So yes, there's oil and gas companies, and you might say, yeah, but Alpesh, look at how much they've fallen off. And if it just goes back to 921, we would have made a killing. We'd, I don't know, increase our money by 50%. I'd say, yeah, that's fine, except I've just said to you, the market might fall back a bit. It might just go nowhere in that time frame. So can we in this universe find slightly better ones? All right, now I'm not going to go through every single one of these, but let me just scroll down a bit more. You can always, I say, take a picture of these things. We're down to number 43. Let's go from 43 lower. Okay, and like I said, what you're looking for, and I will post this on my Telegram channel, are ones which have got slightly better croakies and higher Altman scores as well. Okay, so we'll do this in due course. We've got, for instance, this one. Now, I don't know what Sand Group does, but I know it's got a croaky of 12.6, not too bad. It's got a value growth rating for me, quite high. It's got Altman score. So let's have a look at that one. I might then look at it and say, right, okay, it's at 600. We're talking about it going to 750. It's not much of a move up. Well, you know why it's not much of a move up? The company's already healthy. That's why it's not had much of a decline to begin with. So you see the trade-off. If you want ones which are financially less healthy to try and give you that bigger bump up, you're taking a bigger risk. What we're really trying to do is find ones which have fallen but are financially healthy, okay, because they're going to give us the bigger return. And I will post this on my Telegram channel as we go through and research more of these. But this is to give you an insight into some of our thinking on the viability of companies. Now we're at 83. Let's just move from 83. Let's look at the next batch. Okay, again, these, you can see they've fallen, what percentage they've fallen. It is an exercise of going through a higher croaky, higher Altman score. Now let's go the other way. Let's go the ones which have really fallen off a cliff. Let's even say over the last 3 months, which have fallen the most over the last 3 months, right? Now you might say, oh wow, Alpesh, that's fallen 90%. That means there's a tenfold increase if it goes back to where it was 3 months ago. That's fine. My only concern is croaky scores Altman are quite low. You might say, well, I don't care about that, Alpesh. That's fine. If you don't care about it, you're taking far greater risk. Okay, so this is the other end of the spectrum. And just so you know the maths, if something's fallen 50%, like WPP Group, then if it goes back to where it was before, you're doubling your money. Okay. However, can it go back to 1,000? The question is, and by when? Well, let's say I say within 12 months, for argument's sake, but I'd be willing to hold it for longer. What my job and my team's job is then to look at this, and let's just look at WPP as a good example of something which went down 50%, so would double the money if it went back up. Croaky 9.1%, I can live with that. Altman score, well, it's not going to go bankrupt as such a big business, so I'm less concerned, but it is in sort of financially, it's probably not going to bounce up too much either, because people are going to be worried about their debts and so on. Let's just have a look at this housing company, because obviously people are concerned about housing, falling off a cliff. Good Altman scores because they've got a lot of retained earnings. They've got a lot of working capital, these companies. They're cash rich. They're good at generating cash flow when they get going. Value growth rating of 6. Could double the money if it goes back to where it was. It's currently at 387. Could go, call it 400. Could it go back to 800? Let's assume for a second it could. That's doubling money. How long might it take? That's the question. Now, I might say to myself, well, I think it could do that in 12 months, given the injection the government's putting into the economy. But let's say it took 2 years. Right, so I doubled my money in 2 years. Let's say it took 3 years. I doubled my money in 3 years. Doubling your money in 3 years is something most people would be willing to live with. My point being that the ability to extend the timeline when it comes to investments helps reduce and mitigate risk. Can you see the interaction between quality of company, likely return, the ability to extend time frame? People sometimes say to me, Alpesh, and somebody asked me this morning, Alpesh, got a particular stock. Let's just keep Redrow for an example. Should I put a regular stop loss as I normally would of 25%? I said, well, let's look at what your strategy might be. If your strategy is, here is a company I think could double my returns in 12 months, but I'm willing to hold it for 2 years. Then if it doesn't do that within the next 2 years, and you might take some profits whilst it goes up and up and up, but it doesn't actually do it, then you might say your stop loss is the timeline. Okay. Equally, if new information came in and let's say they banned all private sales of all homes and confiscated all private property, yeah, you might want to get the hell out. Do you see? Under these circumstances, your stop loss depends on your strategy, not on, oh, I've got a 25% stop loss. Unless your strategy is, I'm just trading Redrow, in which case, yeah, you might have, if it drops 25%, you might have a stop. The stop losses depend upon strategy. You got to remember what the point of a stop loss is. The stop loss is a point closest to the entry price where you know your strategy is not in the time frame you had imagined likely to play out. So there are reasons why, for instance, with Amazon, I have no stop loss because I'm holding it for my great-great-grandchildren. So if it drops 25%, I will buy more. Do you see why I wouldn't have a stop loss in that scenario? Okay, so I'll just scroll down these in case you want to take some more pictures of those. That's just the UK ones. If you'd like to ask me a question, if you'd like to have me look at US ones, let me know and I will do that. If you want me to look at well, let's just look at the US 500 largest. Okay, so this is their 3 month, and you can see the Croquis value growth rate, that's pretty low. I want higher Altmans than this, and you can see why the ones which have fallen the most don't actually have good, healthy scores. Why? Well, there's a reason they fell the most. Okay, equally, the ones which have risen the most, like Citrix, will tend to look at that Altman score 5. Right, value growth rating 6, which is good in this environment. Croquis 24. Okay, but it's already up 26%. Alpesh, I want something which isn't. Yeah, well, look at this. It's at an all-time bloody high. You know what Citrix does? Webinar conference solutions. So you might say, well, I don't want to get into that, Alpesh. It's an all-time high in this environment. Are you bloody kidding me? Overpriced. Well, may well be. That's why this end of the market, we've got to have a different strategy for it, which might be, well, it's a healthy company. I think we'll always work like this. I might get into it. I'm not going to get into it because I think I don't want to get into things which are just making new highs. Others might say, well, I don't have a problem. I think it's still undervalued, blah, blah, blah. I will possibly look at those later. This is the top end of the market. Just so you know, Regeneron Pharmaceuticals, if you've been following my Telegram channel, you know we've mentioned this already a few times. Clorox, this is the danger. Goes to 21. Drops back to 17. That's why I don't want to be buying stuff at this end of the market. In fact, I want to look at the bottom end, but then I want to look at the Croquis and the Altmans. That gives me a balance between risk and reward. Okay, so hopefully that explains everything. Got a great question here, right, from Rene. Do you use return on invested capital, or are you sticking with Croquis and Altman? By the way, thanks for the great webinar. My pleasure. I don't have a problem with return on invested capital. The Croquis is a more sophisticated measure of that because it focuses on cash flow, whereas return on invested capital can lead to some accounting shenanigans whereby you could call forward receivables which you've not received. Let me put it this way. In this environment, for argument's sake, I'm supposed to be getting paid $1 million next month. For argument's sake, that would show up potentially on my return on invested capital. It won't show up on my Croquis because where's the cash flow? It's not in my bank account. And guess what? I'm not going to get it in my bank account because the guy who was supposed to give me that $1 million under a contract, hey, he's about to go broke. Do you see? And how do I know that that's why Croquis is better than return on invested capital in this environment? Because the business secretary, Alok Sharma in the UK, yesterday did an announcement how they're lighting the laws on insolvency, trading whilst you're insolvent, because a lot of companies will otherwise go be trading whilst they're insolvent, which is a criminal offense if you're a company director. I used to be a barrister, I used to specialize in company law. So I'm joining up some of these dots, and I'm saying with the economics and the investment I know, and saying to you, Croaky is actually better than return on invested capital. Return on invested capital is going to, at the moment, be a bit like looking at historic price earnings ratios. Yeah, great. A company was really profitable last year. It's not very helpful for us at the moment. I will, on the Telegram channel, also put up, as you will have seen. In fact, I'm going to show you that channel in just a second. I will put up some of the companies based on how much upside I think they've got on analyst estimates going forward, because analysts are estimating these things. They're then telling their wealthiest clients how much they think something's going to go up. Okay. And that's a good indication for me, because then that gives me more of an idea. By the way, my assistant has literally, whilst we were speaking, put on the Telegram channel. Let me just put this, sorry, 1 second, guys. Let me just put this up on screen so you can see it properly. She just put up the economic data for, oops, my fat fingers, excuse me 1 second. You can tell we're live because I'm doing all of this. What she's done is, trying to get this bloody, there we go, diagonal line across. What she's done is shown this image, which is the data which is coming out today. Now, I don't trade around data, but just so you know, in this environment, you might want to keep an eye out for some of this stuff. Home sales. This is US time, by the way, because it's American stuff. So this is some of the stuff which is due to come out from the US. I will just show you. Oh, these are the things we're looking at right now. For those interested who are using my trading software, then these are the trades that we're looking at for the next indicator. Sometimes people get confused. They go, oh, that trade already happened. No, we're also looking for the next signal on that. But that's on trading, okay? So you've got Alcoa, you've got Ethereum, you've got Euro, Australian dollar. Whilst it's falling at the moment, we'll look for the next trade as well on that one. I have posted, and I will continue posting on the Telegram channel, the latest report from Goldman Sachs on what they're seeing happening in the markets. Okay, so I will post that up as well. This is where we are with the Standard & Poor's, the S&P 500. We're over here. What I'm saying to you guys is I think there is a 60 to 70% chance we can break through below this low. Doesn't mean it's certain. I'm only saying the 60 to 70% chance. And this is what Bank of New York Mellon and Bloomberg did the various calculations, if you're interested, on the Standard & Poor's, based on how much earnings, profits of companies decline. Now, earnings are not going to stay the same, obviously. They're going to at least decline 15% overall on the 500 largest American companies, maybe 25%. And if the multiple at which companies trade, in other words, all companies trade at a multiple of their profits. So if some company makes $1 in profits, let's say you're a company and you make $1 in profits a year. I might say, hey, John, can I buy your company for $10? Why would you not sell it to me for just $1? Well, because why would you? If you're making $1 in profits every year, you just keep your company for a year. Why would you sell it to me for $1? You want to sell it for a multiple of future earnings or projected earnings. So you might sell it for $10. Anyway, so those multiples, if the multiples go down 14%, because we're a bit pessimistic about the economy, et cetera, then the Standard & Poor's would go down to 2275, all right? That's roughly around the areas it's at already. Now, you might say, well, actually, what if it goes down 35% on the multiple and a 25% decrease in earnings? Then it goes to 1.7, all right? Where does 1.7 take us? As I say, that's all on the Telegram channel anyway, but the reason I put it on there, let's go. The reason I put it on there, because these things move quick. So you can see we're at 2.541. We'd go a lot below that, all right? If you haven't got the channel, I'll give you the URL in a second. These are some of the things that I've just put on there over the weekend, again, from Bank of New York Mellon, distribution of daily S&P 500 returns. You can see, yes, we've had some outliers, big moves on the upside, obviously big ones on the downside. That was just more for your image. I'm going to post more of these. I'm particularly liking these at the moment because I can't rely in this environment on what historic earnings were. Companies are not just doing what they were doing on their investment basis. Normally, we would project their earnings and their ability to generate cash flow on a straight line. Okay, we can't do that at the moment because everything, obviously, in this environment. So instead, what I'm looking at, the closest thing I've got towards looking at something in the future is I'm looking at what are the big banks telling their wealthiest clients in terms of not just buy recommendations or strong buy, but also their average price targets that they have. Because what they're telling their clients is, here's a company, its price target is $235. In other words, you've got a 48.5% upside. I'm going to post more of those because I'm going to have to rely upon that more. There's no point me in this environment saying to you, hey guys, you know what? I'm going to rely on historic price earnings ratios when have you looked outside the window? So I'm going to have to look at things which are more forward looking for investments and then come up with equities based on that. And that's what I'm going to post on the Telegram channel, and on, for those of you who are part of my investment course and who are using my investment software, you'll see that. So there's ones with 25% upside, lower risk, strong buys. There are others which 48%. Now, how long would they take to hit their price targets? I don't know. It could take a year, but I'm willing to wait for those things. Okay. And I'll also, for those on my investment course, show you some of this stuff, which is, okay, let's look at what's got the least liabilities and return on capital. There you go, return on capital. I couldn't get the croaky on the bit here, so I put return on capital for that, and T. Rowe Price, and that's why I bought T. Rowe Price, and you'll know that if you follow the channel. So you can see the reasoning behind some of these things, but that's what you must always have. We're not here to speculate. We're not here to gamble. We've got to have a solid reason. In my case, because I've got to be able to justify it to our investors, which are pension funds, and in your case, because you've got to justify it to yourself. You know, I like I say, I sometimes have people who'll say to me, oh, just thinking, you know, I'll just put a bit in this and a bit in that. No, if you want to gamble, that I'm not the one. Sorry about this. Let me just turn that video off for a second. And I'll also explain, like I said, my favorite indications on this. I can't go into all of that right now, but anyway, that's all up there on the Telegram channel. So I'll just close that for a second. What I did want to show you was exchange traded funds. And well, we were looking at some of the US ones, but I want to show you exchange traded funds for a second, because I've said to people that I'm going to concentrate a little bit on that. So let's just look at some of these, and let's remember, and when I wrote in the Financial Times, my Diary of an Internet Trader column, I would always be talking about how great these things are. However, since then, there's a whole bunch which are incredibly risky, and there's a whole bunch which are as safe as ever. Most brokers, UK or US, will allow you to buy exchange traded funds just through their regular platform. Okay, now let's look at some of the more risky ones, not because I'm recommending them, but just so you're aware. Yes, there are crazy returns like 1,600%. I wish I had that return. I didn't. It's a 3 times leveraged Latin American ETF. If look at this, down, 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 goes down, and then suddenly shoots up for whatever reason, God knows what. So somebody who put in 1,000 just made £100,000 in profits. I mean, ridiculous sums. I think I've got my maths right, but anyway, ridiculous sums. That's triple leverage. Anything triple leveraged is incredibly risky, right? Now you might say, well, Alpesh, I see oil is at $20 roughly, and I'm thinking of, I want to get some exposure to oil, but I don't want to buy Shell or BP. I'd rather get an exchange traded fund. The only thing is, if it's triple leverage, yes, for every dollar gold goes up, you go up $3. But equally, when it falls, the leverage means it is high risk. This is high risk, okay? I don't mind holding it for my personal circumstances. I don't know your personal circumstances. I don't mind holding it for my personal circumstances because I am willing to have oil, which I might hold for a year, 2 years, where I think it might go from $20 back to $60. So that's a 3-fold increase, plus it's triple leveraged. So 9-fold increase in my money. So for argument's sake, 10,000 becomes 90,000. Now you might say, ooh, I like the sound of that, Alpesh. Hang on. What if you can't wait that long? What if it doesn't? What if I'm wrong and it stays at $20 or goes to $10 or goes to $0? Because at the moment, the biggest concern is the world can't store the oil as quickly as it's being pumped out, and it costs more to store the damn thing. So you might as well give it away for free. It's a liability. It should have a negative price. You should be paying somebody to take it off your hands. Just bear that in mind. So let's just look at, before we get greedy, the fear factor, genuine. Let's say it goes to 0. Could you bear to lose that 10K and it goes down to nothing? Because that's the way you got to look at it. I'm afraid we live in a crazy world. You might say, Alpesh, you're wrong. I think your assessment of oil is wrong. I think it might go worst case $10. And therefore, if I get in on triple leverage, I will make a 9-fold return on my money. and I'm willing to hold it for a year or 2 years. Now, that's my scenario, my analysis, but I'm just sharing that with you. I can do that based on my risk profile and my bank account. You might not be able to. So this is not a recommendation and financial advice for your pension, obviously. It is just giving you an insight into how markets operate and how we're thinking at the moment, okay? The most popular ones you might want to look at, because you might say, Alpesh, you know what? I really want to look at the Dow, if I can find it with so many bloody Dow ones. The Dow, it's in there somewhere. All right, it'll be in there somewhere, and I can't find the ticker. But anyway, there will be a Dow tracker. Let's just say S&P. Okay, S&P. Whoops, S&P 500 for argument's sake, and then let's say we go SPY. Obviously, Spider. SPY. It's another. Oops, SPY. Give me a second, guys. SPY 5. Okay, Spider S&P 500 ETF. There we go. Duh. Now let's have a look at that. And you might say, oh, you know what? I think the Americans are going to come back. We're at 26 on it at the moment. We'll go to 34. And you might say, well, that's not actually much of a rise. That's not much of a rise at all, Alpesh. So you might say risk reward. Yeah, I can see why an index tracker, because it's a basket of stocks, is attractive, but I'm not getting the rise. And that's the risk reward trade-off, because you know what the risk reward trade-off is? It's the fact that you've got the reward of it going up, but the risk is mitigated. So the reward is smaller because it's a basket of stocks. For those who don't know what these things are, and like I said, feel free to put more questions up. I'm just going to take you through one of many infograms on exchange traded funds. For those who don't know, they're a basket of stocks. Okay, they're on everything from stocks to bonds, and your normal broker will offer these to even foreign currencies and oils. Okay, the reason they've become very attractive is because they're a basket and they're relatively low cost. Unlike a company stock, the number of shares, blah, 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 that bit doesn't really matter. It trades like a stock, all right? So because you're not spread betting and leveraged on this, you can't lose more than your initial investment on it, all right? Because you own basically a fund, you own some shares. That's what you do. And these are the various types. So those of you who are looking at indices because you want to take a view on the FTSE or the S&P, they're good index trackers. But if you start trading them and don't have a proper strategy, that actually I'm willing to wait for the market to go back to where it was 3 months, and I can wait a year, 2 years, 3 years, then you can work out your return. Right. But if you haven't got a strategy and say, I'll just buy some, and then by this afternoon it's fallen and you think, oh God, I'll get out, you're just going to lose money. The inverse ones can be interesting because they rise as the broader market falls, so they can be used for hedging and vice versa. Right now, they're designed actively managed funds, unlike ETFs, but there are some actively managed ETFs, oddly enough. I'm not going to recommend, we're going to stay clear of because we just want to track certain things. That's what we're going to focus on. There's also exchange traded notes. Just treat them like treat them like an exchange traded fund. It's more a technicality what they are, but anyway, they're debt securities backed by the creditworthiness of an issued bank. They basically work the same way as an ETF for all intents and purposes. There's a few other benefits compared to an ETF. Anyway, why invest in them? There you go. Right now, I'm not telling you to necessarily invest in them. I'm just saying when I wrote my FT column, they were very good as index trackers because they were cheaper, and most active investment trusts don't beat those. Okay, so there you go. Those are the pros and cons, and you know it speaks for itself. It speaks for itself what the pros and cons are, right? And like I said, I've been a fan of them for a while, but not the more risky ones unless they suit my profile. So yes, I do have, for instance, Amazon 2 times leveraged and Apple 2 times leverage on an exchange trade fund. Why don't I just do a spread bet or a CFD? Well, because I want to hold them forever. So this is more suitable to that. And I also have double leveraged FTSE. Now, if you speak to your broker and you say, you type it in online, say, what's FTSE ETFs have you got? They'll have some standard ones and they'll have some double leveraged ones. Just as a reminder, Amazon leveraged, there's the ticker. There's the Brent crude oil 2 times leveraged. I have no problems with those. There's the Apple and there's the FTSE 2 times leveraged as well. No issues with those either. Okay. Now, guys, that's a bit of a quick run through. If there's no questions, I'm going to get back to the markets. I'm a bit behind schedule today. So I want to thank everybody who's been on this quick clinic. If you've got questions, please put them in to the chat box now. Otherwise, I will assume you have none. Oh, by the way, yes, in terms of where to go for the Telegram channel, go to pipspredator.com, useful links. You'll see the Telegram channel there. and you'll see some of the picks that I'm putting up and the analysis, during the course of the day that I put up as I put it up. Okay, so pipspredator.com for that. Most of you would have got this invite anyway through the Telegram channel, so you'd be fine on that as well. Any other questions? If not, I will disable screen sharing and I will call it a day. I'll try and do more of these. I don't know when. Obviously, as you can imagine, things are a bit busy for us as well on the trading side. It's, like I said, as you can imagine. Thanks everybody for being on here. Hope you've enjoyed it. Hope it's been useful to you all. So I just want to thank Keith, Dippin, Lionel, Dimpy, you're on here as well. Dimpy, you've got access, as has Philip, to the investment materials, the investment software for the longer term. And so if there's any issues there, just let me know and I'll make sure that on the course, have a look at that course material today, actually. I can see you're both on here. So let me just show you some of the latest stuff I've put on there from Goldman Sachs that I got over the weekend and this morning. If I can. Excuse me a second while I find it. Anyway, look, it's over here. Please look it up. Philip, Dimpy, and anybody else who's on the investment side, because this webinar is more on the investing, unless you've got questions for me, anybody on the trading side. But what I've just put up today is the, where's it gone? Goldman Sachs Navigating a Bear Market, that report they've just issued this morning on just what they're advising their clients, and also have a look at the JP Morgan one. I don't think a lot of you will have seen this on the investment course. Whoops. And have a look at the Goldman Sachs report on the virus as well. I literally put that up since yesterday. So all of you who are on the investment materials, please keep a daily lookout on the Telegram channel plus this. The helpful thing is whenever I update something on this, you'll see a green light. It'll show you that you have not yet read it. So you'll know what you haven't read, okay, straight away. And that'll be very helpful to you. It'll be useful to you. And also don't forget to download the software, the investment software on there. And we'll train you up on both the investing side. And of course, you've got the trading side generally as well. And just in case anybody's wondering what we're looking at the moment on the trading side, you can take a snapshot of this. But I'll try and post more stuff up. There's some of the ones that I'm looking at, plus we've posted on Telegram. Listen, guys, I'm going to go. There's no other questions, so that's good. It's great. There's no questions. I clearly must have done well. But thank you all. Oh, what have I done? Oh, what an idiot. I wasn't sharing my screen, and none of you even said to me that you're not sharing your screen, Alpesh. We couldn't see a thing you were saying. Right, sorry. Here we go. Share your screen, Alpesh. It shows nobody's paying attention either, doesn't it? On the investment course, this is where it is, and what you can see on here. All right, so Philip, Dimpy, and anybody else who's on here, what I want you to do is have a look at this one I put up this morning, which came from Goldman Sachs, the Goldman Sachs Navigating the Bear Market, the JP Morgan one from last night, and the Goldman Sachs report on the virus as well. I will go through these myself in detail for you and explain what we're looking to acquire, what we're looking to buy, where we think the returns are, but these will give you, I put these on straight away. Then my team analyzes them and works out what the most relevant things is. I analyze them as well and work out what the most relevant things is. So on the investment course, please, those who are looking at that, go through that. And for those who are on the pipspredator on the trading side, these are the things, as I said, we're looking at. There it is, what we're looking at. Okay, guys, thank you all very much for being on here. I hope you've all found it incredibly useful. Really appreciate it. Thank you, Philip. Thank you all very much for being on here. Thank you.